Welcome back, everyone, to Investing for Generational Wealth. Let us dive into the world of expert financial insights and strategies. Before we begin, just a quick disclaimer that we are not financial advisors. We're just two guys on the internet talking, chopping it up. So not financial advisors, not legal advisors. Investments are all subject to risks, including the possible loss of the money you invest. So perform your own due diligence, invest at your own risk, talk to your own financial professionals, CPAs, financial advisors, etc. Before beginning, I'm your host, Keshav Kolor, and welcome to today's episode, How to Raise Private Capital for Real Estate. And today's guest here is Mathew Owens. Mathew, thank you for taking the time to come speak with us today. And
no problem.
Tell us a little bit about yourself.
Yes, sounds good, man. Thanks for having me. I really appreciate it. I love educating people on these different topics of financial education. I am a CPA, so it kind of runs in the blood a little bit with regard to the passion for this. And so I grew up in Southern California. Graduated with a degree in economics with an emphasis in accounting, and went through and became a CPA afterwards, doing audit and tax for different real estate companies, and primarily focusing on the real estate side of things while I worked in public accounting. So a lot of our clients for the CPA firm were real estate related and doing different development projects. So I got to see kind of the inner workings of this stuff from the multifamily side, and a lot more fun than doing actual real tax and accounting work, for example. Since then, I quit my CPA firm job in 2006 to go into real estate full time. So I was a real estate genius for about a year and a half before I got punched in the face by the market crash and learned really good. But since then, we flipped a little bit over 1,000 houses now. We have over 35 million lent out to flippers in different markets around the country. I've raised over $150 million for real estate transactions over the last, 16, 17 plus years. And we raise money and invest in a lot of different syndication investments now, from mobile home parks to debt to multifamily to a multitude of different asset classes that we like to focus on. And primarily have our own internal operations with debt and equity investments in single family and multifamily and mobile home park type deals. So it's a lot more fun than doing taxes and accounting and doing tax work forever and helping people pay more money in taxes.
I bet this time of year, especially, you relish that decision every time.
Exactly. It's pretty funny. I actually became a CPA because I was going to UC Santa Barbara, and I wanted to be an architect, but they didn't have architecture school there. So I'm like, you know what? I'm just going to become a CPA because my dad was a CPA, and my dad's going, "What's wrong with you? You're never going to get spring break again. Like, it's tax season. It's like 80 hours a week every year in tax season." And I was like, "No, I'm going to become a CPA. There's too many girls at this school. I got to stay here." That was my train of thought when I was 18 years old, deciding which profession to go into, or 19 years old,
Yeah.
So
Sound reasoning.
pretty great thinking then. Say it again.
I said totally sound reasoning.
Yeah, exactly. So what every 19-year-old or 18-year-old kid, their reasoning. So
Cool. Well, I know you mentioned a lot of asset classes that you raise capital for, which I would say, what's your top three? What are your top three asset classes that you like?
So I really like investing in debt, and being a lender in different ways. It's really interesting to make spreads on debt between what I pay my investors and what I lend the capital out at, and how much my expertise as far as due diligence helps with that, and my ability to analyze deals and make sure that there's profitability there and the right checks and balances are met. Because we flip so many houses, it's a nice spread. I'm sick and tired of dealing with single family, so I don't think I'll ever buy another single family house as long as I live. But that's what helped me build my wealth as well, to get to the point where I could do a lot more private lending and work in that aspect, and also raise investor capital and invest myself in debt, in loans, to create short-term cash flow. And so, there's different strategies that investors want to take when they're investing, depending on the asset class, right? We invest in promissory notes, for example, like I mentioned, usually short-term construction debt, where it's a 12-month type loan, usually 65 to 70% of the value of that property when it's finished. And then we also invest in a lot of mobile home parks, and I also invest in a lot of debt instruments that may not necessarily be related to real estate, debt invalidation. We're creating a mobile home debt fund right now as well. Different debt structures in these ways, which give us some extra collateral involved because the equity owner is usually the one putting the excess capital in. I do love investing in mobile homes and multifamilies. At the same time, that's a different strategy, right? The promissory note strategy and debt strategies a more of a cash flow strategy because you're not getting major upside on the asset value, right? You're not getting the tax benefits, which the real estate, when you own that, you're going for big tax benefits. You're going for, the long-term wealth building effects of this. And the cash flow may be a little lower in the beginning as they're doing their value add on that project, for example. So, they come with different benefits, but I like them both for those different benefits. And I think it's important to have both because everybody needs that set, steady cash flow stream, but they also have to compete with inflation, beat inflation, and, create that wealth long term too with passive investments that they don't have to, constantly manage themselves, right? So those are the typical strategies I really like.
Okay. I'm just plugging my mic in 1 second. Forgot to do that. Um, what was so you mentioned that you quit being CPA and got into real estate right before the crash. Walk us through that journey a bit more in detail. Like, what was your first deal like? And then how did you progress from where you were back then to where you are now?
For sure,
Like
man.
big milestones.
I'll say a lot of pain, right? Like you go through a lot of pain, and it's what pain is what really moves you, right? I was sitting at the CPA firm doing taxes and audit for multiple companies. I was really good at it, but honestly, I was bored out of my mind and just going, I can't do this anymore. And it was that pain that to say, what else can I do? I mean, should I open a bar up? Should I, what should I do? I had no idea other ways of making money, and other strategies other than, hey, go get a job, go to school, get a job, work for somebody else, and consistently, grind until you work up the corporate ladder. I knew there was entrepreneurship out there, but really wasn't a networker at that time. I was more someone that didn't want to talk to people. I was nervous and, insecure at the time, I'd say, comparatively, as far as getting out there. And at the end of the day, I was just so bored that I couldn't deal with it. And my stepbrother calls me and he's like, "Hey, come check out this class. These are like a real estate class that people are, it's like 2 years of education." I was like, "How much did you pay?" And he's like, "Oh, 16,000." And immediately I'm like, "You got jacked, bro. Someone stole your money right now." And that was my mindset at the time, right? I never paid for that education or paid for that outside stuff. And that was, now I do that all the time. I just paid, a ton of money for different masterminds and different things like that because of the value that I know for a fact that they bring to the table once I have enough resources myself to be able to take advantage of those things, right? And so at the end of the day, I was bored out of my mind going, what do I do? And my stepbrother came to me with this course and I ended up going. I was going to flake on him. But I ended up going at the last minute and I was immediately drawn to real estate. I saw a strategy to make money and I saw entrepreneurs around me that really wanted to do the same thing. And I was exposed to that entrepreneur type journey, and I ended up going and getting my first deal under contract in Memphis, Tennessee, where we were going to flip a duplex, me and two stepbrothers of mine. And we are going to go flip a duplex and make 30 grand on the flip. And we ended up getting under contract. And I was right in the middle of the 2 years of education on it. And I just quit my CPA from job and said, "That's it. I can't do this anymore. I'm going to go jump and jump ship." I think I had like 30 grand saved in the bank, and that was about it. And I said, "Forget it. If I have to, I'll go get a job again. Like, I can't do this." And of course, I didn't have kids at the time, so it's a little easier. Now I have a 5-year-old and an 8-year-old, and there's a little more risk there. But so I quit, and that was like 2006. So I was a real estate genius for like maybe a year and a half before I realized I was not a real estate genius. I didn't know what the hell I was doing yet, And we went and got an office at the World Trade Center in Long Beach on the 23rd floor, or overlooking all of Long Beach. It was like 5 grand a month. My two stepbrothers that were computer programmers computer programmers and electrical engineers both quit their jobs and jumped in with me. So we have massive overhead, selling a lot of houses really fast because it was like the top of the market. And then, of course, the market turned, and we had just basically bought 36 properties, all with our cash and our private investor cash. And we ended up taking the hit ourselves and going down with the ship and aren't paying our investors back. And at that point, we just lost everything, and I hunkered down. We split partnerships with everybody so we could just go our own ways and hunker down. And we were trying to find a way to make it work. And then because we took the hit for our investors, we started doing joint venture flips with investors, and we would make like a $5,000 acquisition and rehab management fee for doing all that workload involved. And then we started doing 5 of those consistently. And that's how we started to build our base of properties and flow at that time, to be able to buy those and hold those, or buy those and flip those properties as well. Out in the Memphis market while we were here in Southern California, living, and had our team out there that we rely on got stolen from every way you could possibly imagine in the beginning, learning not where not to buy as far as what properties and areas, and doing literally everything wrong, but just learning through that experience and, taking the punches in the face as they came, and things like that. And you become extremely strong because you go through all of those trials and tribulations, and you find every way to maneuver and adding tools to your tool belt. For example, when you're selling a house in 2008, that's a hard sell. 2008 to 2012, we had to learn a seller finance strategy that would enable us to sell properties to international investors in Japan and China because they could get massive tax benefits, and to people's IRAs and 401ks because we could create the financing and give them loans into their IRAs directly on 15-year loans, and then we could sell the paper off on the secondary market. And so we learned that strategy, and that's when lending was born, right? And we started borrowing more or raising more money than we needed for our own projects, and then we started being able to lend it out to other people and learning trials and tribulations along the road that way too, realizing, wow, not everybody is a CPA that knows how to manage their money correctly, that knows how to deal with rehab bids, and and so you go through the punches in the face and push through and grind, and that's what makes you crazy strong later and gives you the ability to really build long-term wealth. Don't think that it's just invest it and forget it. Yes, there's strategies where you can do that, and you can invest with other people that are already experts that have already gone through that pain, and that suffering in the space. But if you're investing with new people, they haven't gone through that pain yet. And so you want to be able to make sure you're working with the right operators if you are investing with other people. So these are all the things, that the fun things you get to not hear about from operators out there, because they tell everybody everything's perfect, right? So, and you take those punches and you keep pushing, and you find the solution to get out of those issues, right? So lots of
Yeah.
fun.
Okay. So for all these projects that you raise capital for in the past and even now, what's your current process? Let's say you find a new investment opportunity, like walk us through, hey, this just came across my desk, to closing on it. Like, what are the steps? How do you talk to investors about it? How do you actually get to the finish line?
Gotcha. So actually, it's a lot simpler than it seems. A lot of people think, hey, when you're talking about what's the process to take them from start to finish, finding the deal, being able to do the due diligence on the deal, finding the capital source or sources, as well as closing on the deal, and then you have operational efficiencies afterwards and making sure it's being managed correctly long term, and that you have investor communication happening consistently. So there's a lot, of course, to unpack in a complete process like that, right? Obviously, on the front end, you're doing a massive amount of deal review, constant deal review, constantly vetting operators in different ways that you want to work with. If you're investing with other people, or if you're investing yourself, you're doing that direct deal review if you're the operator, right? And you're constantly having to analyze tons of deals before you even ever possibly get one under contract. Then you're making offers on those deals, and that's actually a system to be able to do that. If you're dealing with large multifamilies, small single family homes, mobile homes, debt, it all comes with a process of acquisition on that side that needs to be pretty in depth to to find the right assets out there and the right due diligence practices while you do that, including the market, the operators you're working with, the team that you're working with, if it's not, an outside operator that you're just investing with, as well as the deal due diligence on that particular property and as well, right? So you have a lot of metrics to be able to dial in. And then it comes down to, great, you got it under contract now, and that process to now finish up your due diligence while you're raising capital, which you're usually putting together an investment deck, a private placement memorandum, unless it's a small deal, we're using one investor on a deal. You might deal with a joint venture relationship or a promissory note structure just on a smaller deal basis, but on a bigger deal basis, you're going to be looking at a lot of syndication deals where you have to pool investors' capital together to invest in a syndication. And in that case, you're usually having a ton of different investors, and you have to have a process and a system to do that with the right legal documents and the right SEC filing to make that work when you're pooling investor capital together, which means investors can put in 25, 50 grand, 100 grand or more, but they can limit their investment as well and diversify across multiple asset classes, multiple markets around the country. And so that process is preparing the documents, a private placement memorandum, an operating agreement, subscription agreements, and an investment deck, and creating a webinar or a class to teach people this is what the investment's about. This is how we've mitigated risk, or what we plan on mitigating risk within this investment. Here's the team and why we think it's a viable deal and why we think we should be able to make money doing this strategy. And here's the value add strategy we're actually doing, and breaking it down, everything to them about the market, etc. Right? And so you're teaching that class, and there's an email sequence and marketing sequence to be able to get more people to come to your webinar, right? Consistent networking and consistent, I'd say, distribution of content, educational content, to show people and teach everybody in your database, these are the strategies you deploy. This is why, and then having a set email sequence and a launch sequence to raising to a webinar, and then a follow-up sequence afterwards saying, here's a follow-up to the webinar and a last call sequence. Sometimes now you still got to get gritty on the capital raise. You still may have to be calling a ton of investors yourself or your staff, getting them on the phone, text messaging, developing the relationship personally, doing Zoom calls. All of those things are key to being a successful capital raiser with regard to the process of that raise. But the capital raise isn't the hard part. The actual hard part is implementation of your plan, because no matter what your financial projections show, they're going to be wrong, period. And so you have to make sure you've been conservative enough there, and then be able to have the right operational efficiencies long term on that investment to make it work, right? And a lot of operators don't. And so analyzing who the team is very, very important from a success standpoint and a operational long term efficiency standpoint, along with the right communication and risk mitigation for investors. I hope that helps. I know it was a lot to unpack with these different pieces, but yeah, that's how it typically runs.
It definitely does help. What you mentioned, once you get to the capital raise, how you go about, you have these automations that lead up to the webinar, then after the webinar also. And now in this, capital environment, obviously, like you said, we have to be dialing and smiling, reaching out to people, actually. And so, but to get to that point, you obviously have to build up a list. And you mentioned that one of the best ways to do that is content. Could you break that down a little more, as far as like, what are you doing to build up your investor list? And like, what sort of pillars do you see of your, strategy? Like, where there's maybe like an in-person pillar, like networking in person, meetups, etc. There's like a social media pillar, you know,
Right.
just break that down.
I think that's a great question, and I think you can break it down into a couple of key sections of this, right? So the first one is getting yourself out there to your database database once you have a database. Letting, first going through your Rolodex, putting all your friends and family and everybody you know in your database and asking them if they want to opt in because you're going to come out with good education for them consistently, right? You don't want to just blindly put people in your database. You want to be able to get that request and ask for, permission to do that, right? Buying lists like that really come with a lot of risks nowadays. You can get blackballed from, email lists, and your email domain can. So you really don't want to do that, right? You want to be able to have a quality list that's built, that people that want to be in your database that are very attentive to what you're doing. For example, we have a pretty good size list now, and we have over a 35% rate of open rate on our emails. And so that means 35% of people are actually, paying attention to what we're doing to a degree, right? And so and we get different response rates. We get, some people unsubscribe, right? But with a big enough list, that's a consistent thing, along with new people coming on. As long as the new people are and you're is coming in that's higher than the unsubscribes, you're doing pretty good.
Yeah.
And so you want to be able to pay attention to your data on when you do put these people on the list. Now, how do you get them in the lists? You have to consistently teach people, right? And actually care and really, really teach them. You're not selling product. You're not out there, pushing a specific thing. Yes, you want to educate about the things you're doing, of course, and you will make money, but people will come to you when they think and know that they can trust you with what you're actually saying, and you're going to tell them the good, the bad, and the ugly. So that way they are aware of the risks, and you're just acting like a teacher versus an investment advisor on these items. Yes, you have your own projects you want funded. Yes, you want to tell them about these projects, but when you first meet somebody, wherever it is, whether it's an online through someone that comes in through social media, where you're planting consistent content every single week on each platform out there, and then also having a funnel system to bring them back to you, which means that you have to have different hooks in place. And you want to provide value. Like, what's a hook? Something that's valuable to somebody else that they want to download, right? Like, we have a 200-point due diligence checklist that people download from my website, MathewOwens.com, with one T in Matthew. My parents couldn't spell, so I say with one T. But they'll download that and they come into my database that way, but they're getting a 200-point checklist that they can now use to invest with other operators that they want to invest with. I don't care if it's with me or not. Go use that database, that thing, and then hopefully they'll find the content that I have valuable and they like that what they're hearing. And at some point, even if it's 5 years from now, they will invest with us. The social media leads and anybody that comes in through your content most of the time has a client incubation period that could be 6 months to 2 years to 3 years or more, where no one's going to say, here's $50,000 or $100,000 or $1 million of capital from meeting you from a YouTube video, unless they really trust you. And the way they trust you is consistently getting to know who you are and your personality through your content distribution, right? So
Yeah.
that's one way. And as those leads come in, you are meticulous about getting them into your database, tagging them to where they came from, so you know where your most leads are coming from as well. And you're also, through that content distribution, you're speaking on different podcasts, you're creating your own podcasts and your own content. I have a YouTube channel at OCG Masters of Real Estate, and that's consistently out there, right? I'm reusing my content too when it comes to teaching investors, right? In my communication with my investors on my email chains, I have a welcome series. Someone comes into my email database, they go on a welcome series saying, here's everything about me. And here's some education also on due diligence on investments, on promissory notes, on different topics, and, mobile home parks, for example, or the different strategies that I deploy, and even some on the economics and other things that go along with that to give them a well-rounded view, including financial education. And hey, you shouldn't be investing unless you have 12 months of your personal reserves set aside. You shouldn't be investing in other stuff, right? Like, you should have that money put aside for that first, being responsible and teaching them the right ways to invest and the right ways to do asset management on their investments and things like that along the way, to empower them, because the more you empower them, they then give you referrals consistently, and it starts to snowball like crazy because they're excited to be working on the deals that you're invested in because they're good deals and you're doing right by them consistently, right? So So that's one strategy, is that, consistent organic content development strategy and lead flow strategy, and providing as much value as you can. And in addition to the welcome series we also launch webinars where we'll do a topic, once a quarter or once a month on, specific topics. Like we did it on construction lending. We did it on how to create passive cash flow from their real estate investments, on multiple investment strategies, right? We did it on a bunch of topics just to teach people. And we might get 80 to 100 people on each one of our webinars, just to come and learn from us, right? And then so that strategy nurtures that long-term relationship, and then we can have a different sequence that goes off to those people that attended the webinar because that's what they're interested in, for example, right? So that is the content side. The next biggest side is in-person meetings, where you are in your local community throwing events and attending events consistently. In the very beginning, I was going to 4 to 5 networking events every single week for 2, 3+ years, every week, just developing relationships and going to the same reoccurring events consistently, because after those people at those venues see you like the 12th time, psychologically, they know you already, like you, and trust you. They may not like you if you don't have a good personality, but you get the point, right? So, but at the end of the day, those personal relationships build trust 10 times faster than the online content distribution strategy. And so we've been running a nonprofit called For Investors by Investors in Southern California, where we have 6 chapters throughout Southern California. We've been running that since 2008. And that's a reoccurring meeting every single month where we get 30 to 100 people at our groups live in person, where we actually teach with no sales pitch allowed, and then we educate on different topics, and then we do networking afterwards, where we all kind of get to know each other and help each other with resources as best we can. So that's events we throw. We also go to other events and other real estate events and meet people there and get leads at those events, and also promote our own content at those events by bringing flyers or a pamphlet about the other things that we're doing and ways that they can get in touch with us. So these different strategies really work, including, going out and speaking at other people's events too, gets you a lot of clout. So that's number 2 way. Number 3 way is going to masterminds and networking events, right? I'm a member of Raise Masters and Capital Collective, which my buddy Hunter's involved with. I'm actually wearing his t-shirt because he buys some good swag. I'm like, great, man. I'm actually promoting your stuff constantly just because I like your swag, and at the end of the day, groups like that provide value in a lot of different ways, because you're meeting people where you're going to make more money with them on new projects. You're meeting other capital raise partners that can raise capital with you. And so the power of other people and the group is massive when you're looking for resources that can help you do what you need. There's people out there that do nothing but raise capital for their own funds and are strategic investors. You can find family offices, you can find brokers, you can find all different types of relationships and resources through going to these groups. And usually these groups are higher level operators because they're paying money to be part of this group than like my nonprofit that's just generally in the community that is teaching the general public about financial education and real estate education, right? So you get a different level and a different benefit with each one of those different strategies. So organic, the live events that you throw and attend, and then masterminds and things like that are the primary ways, in my eyes, that you should be going out developing this lead flow consistently.
Okay.
A lot. I know. It's a lot.
Hey, the more the merrier. What are you doing in today's environment, again, where everyone's, keeping their cash under their couch, everyone's a little more hesitant to deploy? What are you changing up to, one, find new investors, and then two, cater to your existing investors and, show them that, hey, these times might be tough or uncertain,
Mhm.
but these investments are still, good.
Right. And so yes, with fear out there makes you need to teach more about risk mitigation and show them these are recession resistant real estate strategies, and invest in the right strategies that make sense based on that issue, right? Based on people's perception of the market and where we could be going with the market, right? It's an election year. There's a lot of fear out there and things like that. At the same time, you can be scrappy and make phone calls for those direct relationships, because that trust that they have for you helps massively to be able to have them invest, right? If they've invested with you before, or you're out there and they know your strategies, they just may not be seeing your emails, right? If you only have a 35% response rate, a lot of people are at the 25% response rate even, and you're talking about missing 75% or 65% of your database, right? And so you want to be able to make sure you have all of your current investors, anybody that's ever invested with you, lined out, that you can start hitting them up and calling directly and doing direct reach out to and communication to be able to get that capital in. That's one thing you can do. The second thing is investing in the right strategies. Like, for example, we just took down a 172 unit mobile home park that we're adding 52 units to vacant slabs, and then rehabbing 26 additional units that were down units from the park. And so we're adding so much value to this and doing utility recapture, all that stuff, that once the value add's done, we're going to be looking at about a 13.8% cap rate at our cost, which is insane. And, we're looking at like 60% of the market value. We did things like, upon the refinance, to mitigate the risk of the refinance rate, we bumped that to 9% instead, right? To be conservative. We pretended like the cap rate went from 6.75 to 8.25 on the exit cap rate, so that as if the entire market dropped by like 20% basically across the board. And so in that situation, we're showing, yes, there is risk in the market. We like mobile homes. We like this strategy because we're adding so much value. We have so much built-in equity protection. We're really safe. In addition to that, we buffered our interest rates massively in case of that risk. We went through and pretended like the market dropped, and we're still making a great return on our investment based on our projections. And then on top of that, what kind of asset class are we investing in? Mobile home parks are usually recession resistant, because you always have a multifamily tenant base that can come down and move to the mobile homes if things get really tough, because it's kind of the cheapest form of housing you can have. As long as you have really good property management, good operations there, construction and all that stuff, then then that's a great strategy to utilize long term. And so it's a matter of teaching. Yes, we're looking at this, but our projections are showing as if something crashed or something bad happened and we're still in great shape. So, and that's why, on the lending side, I show people we're at 65% loan to value typically on our, underlying loan amount versus the value of that property. So we're in a very good, safe position. We're on short-term debt. It's usually very liquid in that situation too, so that we can sell the debt off if we needed to recapitalize very quickly. So there's a lot of benefits and pros and cons of doing that strategy. So, in ways you show them you're mitigating risk in this market. If you can't solve their fear, the investor's fear, and show them how you mitigated that risk and what risks you think are there and how you think you mitigated them, they're never ever going to invest with you. So you have to be able to target those things, to be able to teach those things to them and have a rebuttal for every potential risk an investor could think of. Make sense?
It does, yeah. And so one of the things you mentioned, right, is, like you said, how do you mitigate risk for investors? And that's obviously a very important part of your investor presentation. So what are some other typical elements that you like to include when you're discussing an opportunity with a potential investor?
So one of the biggest things I like to show people is, what is our all-in cost compared to the value of that property after we do the value add, because that's going to show you your equity protection in that particular deal, right? And then what's your capital stack, and where is every piece of that capital getting allocated to? And then some of the details of any renovation that's going to be done, the timeline of things that are going to be done. All those things are really important to be able to show investors, the visual picture of the deal in itself. I also like to outline the risks and show specifically how we're mitigating that risk, right? If people are worried because, tornadoes happened or, flooding happened, how are we mitigating that risk with proper insurance in place? And how do we have that cost structure built into the financial projections, right? How do we go through and mitigate the risk of, inflation continuing on your expenses? And, have you built that into your calculation? And how do you mitigate the risk, or what happens when rents drop by 20%? Where's your break even point to where investors are at least break even so they're not losing their money? What's the break even if the value on the value? Can the value go down by 20% and you're still going to make a break even on the money, or make a little bit of money on that deal as well? So I like to show those specific things, because it's like, here's all the ways why I don't think we'll lose money, because these are the risks and how they're mitigated. So if you're able to show that, you're golden, right? And as far as in the actual projections, you also want to go put, or in the actual presentation, the power of the team, what their experience is very, very key and important, because you're investing with the operator, not on a specific deal. That operator can make or break the actual investment, period. So from that perspective, having very clear understanding of who the operator is and who their underlying management team and asset management team is very key.
Got it. And so once they're on board with all the information that you present with them, the way you're mitigating risk, they feel confident. They say, "Hey, Matt, I'm ready. Pull the trigger on whatever it is, 50 grand, 100 grand, 200 grand." How do you take care of them afterwards? What does your process look like there for keeping them in the loop and just keeping that relationship going for years to come?
Yeah, and I think it's important that that process on the back end starts, and that client retention process on the back end starts on the front end with the proper vetting of that investor that's investing, right? What is their sophistication level? Are they sophisticated enough to be investing in this investment? Because there's a lot of investors that are not, that really don't know what they're doing, and you don't want to take their money just because they're willing to give it to you, right? You really want to make sure, because that's going to end up being a major headache long term when they didn't understand something, and they're the ones that are going to sue you later for doing something that they didn't understand, right? And so making sure that that investors vetted up front and they understand the proper expectations, how much you're going to communicate with them consistently, what kind of reporting they should be expecting from you, the fact that they can always reach out and ask questions, setting those expectations up front about what it looks like long term, including on the tax side. What should they expect? A lot of investors don't realize, hey, you're investing in an entity now. That means that we have to wait for that entity's tax return to be done so you can get a K1 and have that flow through to your personal tax return. And by the way, you might have to go on extension on your tax return, because some of these returns can be complex and take some time, and it takes a lot sometimes to get the data over to the CPAs, because they're big projects, and different teams are involved. And so being able to make sure that that is set up front, including what the tax issues may be on this, how that process works as far as taxability, what kind of deductions they could potentially expect on this too, and having them run that by their CPA, of course, as well, is super important. And then long term, you're usually going out and, obviously the operations is key. You're focused 100% on making sure this is operationally efficient and performing the way that your projections are showing as best as possible. And then on the back end, you're communicating that with your investors, usually on a quarterly basis. Many times I do it in the beginning for like the first 3 months or 4 months, every single month. And then after that, I start to go on a quarterly basis, and I do a detailed deep dive saying, this is where we are with the company. This is what's occurring with the project. These are the pros. These are the bad things that happen. Here's where our updated projections are moving forward. And I try to detail those things out so that people are well educated and understand what we're doing. And if something's not performing, then you're going out and saying, these are the things that we're actually doing to fix the problem. Because who knows, a tree fell on a property, or we've had a tree fall on a house before. We've had somebody, as soon as we sold a house to somebody, someone drove through the front window of the house and like ran into it. There's so many random things that can happen that you can never predict in real estate, that sometimes, you have to realize that, and there's ebbs and flows. Many times people think, oh, I'm going to get this level return for the first year, second year, third year. It doesn't like that. Like it's more like a fluctuating thing like this, where you're, getting great cash flow, something happens, getting great cash flow, something happens, but you're looking at the average, and that's what you're trying to target in those projected returns. So really interesting things to understand, and what you should be teaching your investors up front, so that that way they're good long term. And then at the same time, as you do those reach outs to those investors, having individual emails or a campaign of emails just to your current investors, teaching them, giving them updates on other projects you have going as well, to say, hey, a full open book, see all my projects. These are all working, because you never know what kind of cross person would come from, one deal onto another deal, because they just happen to see you're doing well on that deal, or, another asset class, right? So that's what I typically focus on.
Gotcha. You mentioned investors suing. And so what are some legal, and this is definitely not the fun conversation, but it's a necessary conversation.
It's
But
important. Yeah.
when you're raising capital for real estate or any other asset class for that matter, what are some like legal and like regulatory things that you should be keeping in mind when you're talking to investors, allocating capital, etc.?
Absolutely. And so if you are a direct, so first thing is, if you are a direct uh, operator, where you're raising the money for your own deal in this situation, you really have to be very careful of not making money just for raising capital, unless you're a licensed broker. And then there's reporting requirements with that as well, right? And so you cannot legally raise money for selling securities, which is what you're selling, and raise it and make money just off of how much you raised. You're not supposed to be doing any of that stuff. And so if you are, stop it right away, because you're going to basically, either go to jail, or you're going to be kicked out of, doing any SEC work for a long time, as far as, capital raising or real estate deals. And you can be, really financially harmed by that, as well as have legal implications for you. So be very, very careful there. A lot of times, and if you are investing in a fund of funds, where you are creating a special purpose vehicle to compile enough capital to get better terms from that operator and investing with them, then you have to be very careful too. You are now under a different set of laws, where you are now, if you are recommending the investment to your investors, then you are recommending a security directly, which you have to be licensed for also. So you cannot recommend, because they're not investing, the direct LLC is investing in the deal. You're investing in a fund of funds into the stock ownership that owns that deal, not directly into the property in itself, right? And so therefore you are actually selling a security. So in that situation, you cannot recommend it. You have to, hands off. And this is just my opinion. Get your own legal advice on this. There's different attorneys that have different takes on this fully. But my understanding on this is that, if your hands are off in this situation, and you're saying, I'm not recommending anything, here's all the documentation of the homework that I found on this. You make your own decisions on if you want to invest in this. I'm just creating a special purpose vehicle so we can raise 500 or $1 million and get better terms from them. That's it. I'm not actually going and recommending this. I actually explicitly tell you not to listen to me, because you should be dealing with this on your own, and understanding and doing your own due diligence and getting your own attorneys involved. And so what happens is, if you're putting that special purpose vehicle together, then you can make a small admin fee or something for putting that deal on and making money for doing that. But at the same time, you got to be really careful. And like I said, it's different in each state. Each state has different rules. So you want to be very, very careful and get advice from your attorney in that state, both federally and from the state side, to make sure that you are protected there and doing the right structure for this. If you're doing that strategy, right? So that's one big legality, is the legality of getting paid for raising money. Like literally, it's a faux pas that you cannot do that. So and so and then in addition to that, you have a lot of other pieces of I'll say problems that can occur when you're talking to investors, right? And when you're talking to investors, you can't say things like, this has huge upside potential, and this is going to be an amazing deal, look at all this upside. And I think you have to be careful not to gaslight people, and not to say that, this is what's going to happen on the deal, and giving people kind of upselling them on the deal in itself. You're supposed to just be providing documented information based on the projections, not going and trying to, hype them into it by doing different marketing methods, right? So I think you being very careful in that regard on what you can say and not say is key, because you don't want to end up in a situation where someone feels like they were hyped into an investment, they invest, something goes wrong, and that's when they sue you saying you use these terms, and the attorney gets a hold of it and says you use these terms when you're trying to market this, and therefore, they were clawing this back, and you don't have the liability here. Now all the liability for their losses is on you versus being on the deal in themselves, right? So being very careful there is key.
Okay, cool. Well, we have a couple of minutes left here, so just we'll close out with some questions we like to ask all of our guests. So,
Cool.
number one, you mentioned that you've had a very long journey since, slightly before 2008. You also mentioned that there were definitely failures along the way. So, what was the one that stood out the most, and what did you learn from it?
So I think, the biggest one was when I quit my CPA from job in '06 and was a real estate genius for a year and a half, got
Mm.
punched in the face and lost everything when the market crashed and the lending market stopped. And my ego was destroyed at that time. I was like, I have a 790 credit score. We got an office at the World Trade Center on Long Beach on the 23rd floor. And I'm a CPA and we're flipping houses all the time. And like thinking I'm dope. And then you realize, no, you're not dope. It's just the market that was dope at the time, or easy to maneuver, right? And getting punched in the face like that and losing everything, including my credit and all that stuff at the time, having a 790 credit score prior to that, and then not missing a payment was like a big part of my ego at the time. I'm like, no, I don't miss payments, and stuff like that. And you realize you're like, whoa. But honestly, it was the best thing that ever happened to me, because it makes me look out for that left hook right now, where that next loss is going to come from. It makes me pay attention to the economy and what's happening in the market and what's happening in the lending market. I graduated with a degree in economics, but I became an economics major really when I lost everything in 2008, So you realize, wow, now I understand what the hell they were talking about in college, So but that, it makes you really strong, right? Being able to stand back up from something like that. Now, when I take a hit, or if it's even a minor thing, I remember in the beginning going, man, like $5,000 really pissed me off. But now it's like 5 grand, 50 grand, it's like, yeah, that's a lot of money, but wipe it off my shoulder emotionally and focus on how to make it not ever happen again. And so that enables you to look for that solution and find solutions to all your problems very quickly, and being analytical versus putting your head in the sand and going, oh, I can't breathe because I lost 50 grand today or something, like you have to move forward with that. We got stolen from by a contractor for $466,000. It cost me $1 million. And shockingly, emotionally, for the most part, I've been able to be like, okay, focus on this. There was a time where I was like, wanted to go get a crowbar and a blowtorch, but I got to leave that at home, so
Okay. And
yeah.
next, thinking post 2008, right? What if you had to go back 10 years ago, 2014, what advice would you give yourself?
I would say don't sell any houses. Keep them all. Because really, the reason why I was flipping in the first place was I needed the cash from an operations standpoint and thought I needed it to live off of and to handle overhead, right? At the end of the day, knowing what I know now, I would have just raised all cash from private investors instead and focused on that aspect of things, and developing those relationships to do that with all cash in a syndication structure, and held them all long term, which the wealth building effects would have been tenfold. Because as I sold those in 2012, I did not receive the upside potential of all those assets long term. And if you look at this from, it's still the same amount of work to flip it or to hold it either way. And so if I would have just set that up from that point, we would have made a hell of a lot more money long term by just holding those things, and really stopped a lot of headaches and losses down the way, just because of, not selling assets is an inefficient strategy to use by buying and selling assets from the closing costs and the commission standpoints and the tax standpoints out there, right? So
Yeah. Okay. And we'll just end with Where can people find out more about you? What's the best way to learn about and keep up to date with what you're doing?
Yeah, absolutely. Go to MathewOwens.com with one T in Matthew. And like I said, you can download the due diligence checklist. And on there, and we also have a quick analysis sheet so you can analyze any property, any single family home flip within a couple of minutes. So by just having a couple of pieces of information. So it's like five numbers and you'll analyze your flip. So if you guys want that, they're free on my website.
Cool. And what does your hat say?
It says dad vibes, so these are the kids, and
Got it.
I say my son beats me up physically, and my daughter beats me up emotionally. So she's a firecracker right now, and pretty comical. I'll say she's got my personality, just talking trash all the time. So my wife rolls her eyes at me all the time for it. So it's great.
Yeah. Okay. Cool. Well, thank you everyone for tuning in today. And Matthew, thank you for taking the time. Professional real estate investor, or a hard money lender, and in a previous life, 1,000 homes flipper.
Yes, there you go. Thanks,
Yeah.
man.
Yeah. Thanks for coming on. And thank you everyone for tuning in. And until next week's episode of Investing for Generational Wealth.